Top of the morning to you traders. Welcome to the Flow Show with me, Ryan Littlestone, and my colleagues, the K-Meister and Stelios. Good morning, lads.
Good
Top of the morning to you, laddie. Good morning.
How you doing, guys?
Very good, very good. It's raining cats and dogs here.
Is
Weird.
it? Oh, well,
Yeah,
that means you can't go down the beach.
yeah. For another couple of days, then we're going.
It's going to be the weekend.
Yeah.
Yeah, good morning to you guys. Hope you're all well. Quite a bit to talk about today. I'm down to 2 pages of notes for this morning, so
Really?
a lot of scribbling down.
Really?
You okay? Yeah, 2 pages, mate. 2 pages.
I mean, okay.
Usually it's done on the back of a fag packet, but
Yeah.
well, it could just be my messy writing. Who knows? Right. So let's start at the top. China. Not a lot of news out of China, but perhaps the biggest news, especially to do with the Yuan, and let's just knock that up while we're talking about it. Obviously, CNY is the currency they talk about, but the one we can trade is CNH. First things first, they fixed the rate down at 83.88 versus 85.23 yesterday. So a little bit lower there on the fix. Probably a great deal to do with the sell-off you can just see there, which came about pretty much over the date as many US dollar pairs did. But we have had the Chinese press out, and as we know, a lot of them are all state affiliated or have the ear of the state. And a couple of comments. The first one saying that the widening of the US-China rate spread has limited impact on the yuan. That's probably to be the case, but as you can see from the move yesterday, US data and the effects of US dollar are having an impact in this one, whereas previously perhaps not so much. So at least from the dollar side, this is another pair that's being influenced on the US side. But the main comment was that moderate yuan depreciation is positive for export competitiveness. Now, take the export part aside. Basically, that's a green light to say that the yuan can weaken further, saying that the moderate yuan depreciation is positive. That's an inside comment, if you like, that they're happy to see dollar CNY rising higher. The term moderate obviously means that those moves particularly won't be allowed to go too far or too fast. But we've been talking about this previously in the Chinese press and how they can comment to influence what the market may take from price moves. And this, again, as we say, looks like a bit of a green light for dollar yuan to continue creeping higher, albeit in a controlled manner. When we get things like that, you have to watch for the other side. How far will they let it go before we perhaps start getting comments on the other side? But anyway, that's pretty significant in my terms. Kay, you still long a bit at this one?
Yes. Long and patient. Indeed, this comment could mean that they're leaving the door open for a gradual move back up to 7, possibly. Yeah. No,
Yeah,
I'm confident.
Yeah, generally when we trade this one, 7 is the likely big number up here. So if they are going to let it to roam, shall we say, then if we get up to the 7s, that could be where they start to make more of a stand and say enough's enough for that little rally. For those who have been following the show for a while and in the chat room, when we had this big strong move up from 630s up to 680s, we got comments right in the top here. I think it was from the banking and insurance regulator, saying that these sort of moves won't be one way all the time, and that pretty much marked the top. So that's how strong some of these comments can be when you read them. But as I say, for now, a bit of a green light there. Over to Japan. On the COVID front, they're going to start letting tourists back in without a negative COVID test from the 7th of September. And we'll decide on raising the daily limits on visitors coming in. Kuroda is going to be appearing at Jackson Hole, so that's now confirmed. We know for definite there's going to be Bailey, Schnabel and Kuroda. Others to be decided. We do know that we get the full agenda for Jackson Hole tomorrow evening in the UK time, late afternoon in the US time. So as we mentioned, that the agenda coming pretty late as they nail down, I suppose, the final members turning up. What I will repeat again is that sometimes the bigger market moving comments don't actually come from the scheduled agenda appearances at Jackson Hole. They come from the press wagons that are parked up outside. They schedule interviews with various central bank members, and that's where we can get the comments on the sidelines. That's if we are fully back to a pre-COVID format, as I say, where all the big press outlets, Reuters, Bloomberg, CNN, you name it, they all open booths around the area and they take these sideline interviews with central bankers. So keep that in mind as we get into that. Elsewhere in Japan, they're going to be restarting and building new next-gen nuclear reactors. Supposedly, that's not going to start until summer 2023. So nothing that's going to affect anything energy-wise this year. And as we know, it's not a question of flicking a switch and turn the lights on. So that's going to be a long, drawn-out process. But a bit different to Germany. You know, Japan have since the incident that they had some years ago, they've been a bit more cautious on the nuclear side, but now they're ready to ramp it all up again, partly due to all these energy problems coming in. Not a big mover for the yen in the interim, but Kay, you had a comment in the room that's maybe something to keep an eye on further down the line.
Yeah, absolutely.
If energy dependence comes away from oil.
Yeah, so since Fukushima, we have to know that safety rules in Japan, they have closed I think some 20 or so nuclear reactors after Fukushima, and those restarting, they are now having to follow a very, very strict safety rules book, and it takes months, if not years, to even get approval to restart. So the whole process is a lengthy one, but as you say, and as Stelios also mentioned, it is a clear signal from Japan. They want to do something about their energy supply, and I think down the road, as you say, it could mean that it could mean something for the yen, but we'll have to keep an eye on those timelines. I think they are now, before it was 9, but now they upped the number of restarts planned to 17, which is a big number, because there's a total of 23. The article says available reactors that had been shut down. And so reopening 17 of them is an absolute huge number. I think down the line, this could have a big effect on the yen indeed, if they screw down on their energy dependence from abroad. Yeah.
Cheers, mate.
Also, if I can add on Kuroda in the whole, we haven't heard anything from any official after the CPI is coming out in Japan. So I think it's worth tending an interested ear to what Kuroda has to say, because he will be likely asked about the CPI. So really listen to what he has to say, because it could mean, I don't know when he's going to talk, but if it's over the weekend, Saturday or Sunday, he could we could open with a gap on Monday. So be careful with your yen positions going into the weekend, I'd say.
Yeah, that's actually an important point, actually, because this is all happening over the weekend. There is a gap risk potential here this weekend. If we get some big headlines from a big interview, the markets obviously won't be open. So this is one of those times where you just need to be in control of your trades. You know, there is a gap risk, so you might think about taking some profit if you're sitting in some margin, or even closing out your trades and reopening them again after the event in the case of nothing happening at all, but it is a risk this weekend, most definitely. So jumping over now to the US, going to start with the data. Let me take it back to yesterday. So the big news yesterday was obviously the PMI, which in services absolutely collapsed, a bit like we saw in manufacturing in the UK. The services PMI there, 44.1. It was expected to rise to 49.2 from the prior 47.3, but real negative number there. Manufacturing dipped as well, missed expectations and was down. Probably not unexpected going that way, given what we've seen pretty much so far in some of the regional stuff, although it has been a bit mixed. As you can see from the Richmond manufacturing as well, that was out a bit later, that was soft as well. So that's put a bit of a span in the works as far as the economy goes, and probably getting expectations written down for the ISM to come. On the housing front, we got new home sales as well. They were down a chunk as well, as you can see there, but prices were up on the month versus last month, and well up over last year. So I'm still waiting for that final domino to fall to really seal the deal for a negative housing market. We're not there yet based on that action. We also got the not highly advertised Philly Fed Services PMI, not PMI, index rather. And this one, it's never on a calendar, and it always pops up somewhere. I don't know why they don't put it on the calendar. Maybe they don't deem it important enough. Anyway, that came in as a negative as well. So pretty much alongside the S&P PMI that we saw for services as well. New orders were negative, positive prior, but we saw employment tick up and wages and benefits number tick up. So again, you know, that's pretty much showing the theme of the US right now, is that we're seeing some of the sectors showing some weakness, but when you look at jobs and wages, they're still solid or on the up. So that again is a bit of the main area that the Fed want to concentrate on, taking some of this demand out of, and for now it's not happening, which means in their eyes they're going to continue going. Now there was also a bit of news. It's not something I watch all the time, but it just picked up this morning. Now in between Fed meetings, the directors of regional central banks have what's called a discount rate meeting. This is to put forward their views on a interest rate that is pretty much an emergency loan rate to banks. And 2 out of the 12 members voted for 100 pip hikes at previous to the July meeting, or prior to the July meeting. And some in there also wanted a 50 pip hike. Now this isn't 100% reflective of what the FOMC does, but these directors are under the Fed governors, and so it's part of all their decision making. So what it does show is that at least on a regional basis, there is some differentials about what the Fed should do regarding hikes, and these views are taken on board by the Fed governors when they make their deliberations going into the FOMCs. So overall, this discount rate doesn't have effect. It follows what the Fed funds rate does. Whatever they decide at the FOMC, that's what will happen to the discount rate. But prior to that, they do have this discount rate meeting where they put their views forward. So a little bit of inconsistency there regarding the Fed staffers, if you like, about where rates should be. But this is all part and parcel of what we're seeing at the moment with this week running up to Jackson's Holes, the switching between some who think the Fed are going to be dovish, some who think the Fed are going to be hawkish, and the price moves that we're seeing thus. But we'll talk about that pricing in a moment. Now, another small headline, Biden's approval rating has risen to 41%. It's been on the slide for a while. Pretty much as inflation's gone up, his approval rating has gone down. Now we're potentially seeing inflation maybe hitting a peak, and it's probably more so this rating rise on the back of I don't know, we should maybe call it a petrol index, because petrol prices have fallen, I think I saw, for the last 70 days. Now, that is obviously something that the consumer is going to be happy about, and that's probably one of the main drivers in why his approval rating's been up. He'll spin it, obviously, that his inflation busting measures bill, or whatever it was they called it, is working, because petrol prices have dropped, and that makes it cheaper for the US consumer. But anyway, he's a bit more cheerful this morning, and Americans slightly more happy with him. Now, really, the bounce in yields is really telling the story in what's going on. We got this poor data yesterday from the US, or softer data from the US, and everything's followed the same pattern. We've got a drop in yields. Let's go into a short-term chart there. We got a drop in yields, and they've bounced back. The picture is pretty much the same in most dollar pairs. You look at dollar yen, you look at euro dollar, we saw this fairly big sells off, bounces back. And it's what I've been expecting this week, with this to and fro between the market expectations. We see soft data, and the doves react, then the hawks come back in and say not so fast, and we see the market move up. I think we're finding a bit of balance now, because we give or take, we're roughly in the middle, or have been in the middle of yesterday's range. But this is what I want to emphasize still about Jackson Hole. I think there's probably a third of the market is looking for the dovish side, and the rest are still back in the Fed and the path they're on. And Kashkari was out last night as well, and he reiterated pretty much the Fed's stance, is that it's the Fed's job to curb inflation. And they can only relax on hikes when they see compelling evidence of inflation heading back towards 2%. And this is something I keep going on about. The Fed got a kick in because they didn't see inflation coming. They got caught out cold. They made fools of themselves, however you want to slag them off. They've got to show that they've got a grip on this. And it is, in my view, similar to Draghi, it's a do whatever it takes to be right about this. So, as much as we may hear that the Fed may slow hikes, may go from 75s to 50s, and that will be taken up by the doves, as we saw in the FOMC minutes, it doesn't change the picture that they're going to keep hiking. And again, Kashkari has borne that out in his comments in the same speech, because he said, if we in markets are wrong, and CPI is much more embedded at much higher levels than we appreciate, then the Fed will have to be more aggressive, probably for longer, to bring inflation back down. And I think that's exactly what the Fed will be doing. And hence why I'm looking to counter any dovish news from Jackson Hole, unless Powell, really makes a real dovish case to say hikes are stopping, or something as big as that. But even if the Fed, even if he turns around and says, "Oh, we're gonna cut the hikes to 25 pips," the market's going to jump on that for being dovish. But if he says we're going to go 25 pips for the next 2 years every meeting, that's not dovish at all. And I think it's more about how long they're going to keep hiking for, rather than the rate they're going to keep hiking at. And I think that's going to be very important, and it's going to affect my trading and how I'm planning for this Jackson Hole situation. Stel, you got any thoughts on that one?
Yeah, I'm not sure if I completely agree with what you're saying. I think that I see what you're saying, and it makes sense. But I personally think that after the Fed has done the first small little step by saying we're not on autopilot anymore, we're going to see the data and going to go meeting by meeting. If they indicate that they're going to be doing smaller hikes, I think that's the next step, and I think that's really going to be the beginning of the end. So I don't think I would want to go against a weakening dollar if that happens. Then again, who knows what they're thinking, how they're thinking. Theoretically, the Fed shouldn't yet take the foot off the accelerator, but they've already done a little bit of that, right? By going meeting by meeting. So they should have started a lot earlier. They should have gone a lot further, but they haven't. So we talk about logic and about what should happen and how we should trade, but really, I find it difficult to understand what they're doing and to second guess them. So I'm not going to second guess them. What I'm going to do is I'm going to wait until they basically say we're done or we're almost done, and I think that will be the absolute bottom. If I've missed the first 15-20% of a move, I don't mind, because and I'm not talking about FX now, I'm talking about equities and metals and whatever else, then I don't mind, as long as I get a part of the move, I don't mind missing the beginning. But it's very difficult to second guess them and to try to pick a bottom or a top in anything.
Well, do you think right now the Fed are winning? Is there hiking doing the job on inflation?
Well, it's doing the job on the economy going backwards, but inflation, we had one print, which could suggest that there is starting to come down, but one print does not make a trend. So I don't know is the answer. Not yet. I think they will be committed to bringing inflation down. So if inflation keeps going higher on the next print, they're not going to stop. I agree with you. I agree with Mike on the chat. I think that's right. And they've told us this. They've told us so many times, we want to fight inflation. But I tell you what, if the next PC print is again lower, this market's going to go ballistic, I think, because then the Fed is going to be able to say, look, guys, this is kind of working. Plus, we don't want it to completely destroy the economy. All the leading indicators have turned. So we're going to take the foot off the accelerator. That's what they're going to do, I think.
Yeah. I mean, we have got PCE on Friday, which will either confirm or go against what the CPI number is.
Will they have this? Oh, this number will be out before Jackson Hole, right?
Yeah.
Okay, good.
So
they would have had it anyway, right? Even if it was afterwards.
I mean, a lot of my basis behind my thinking for the Fed and the whole is the fact of what all these Fed heads have been saying. They're saying they haven't yet seen the real effects of their hiking, and they've seen some weakness, but they've not seen wholesale numbers. A lot of the Fed members are still pumping 75s. Kashkari and others have said they're going to keep hiking until they see inflation. I think I'm happy. There's a saying, don't fight the Fed or don't go against the central bank. But there's times I'm happy to, like when none of them saw inflation coming. But there's also times when you've got to listen to what the Fed heads are saying, because they're the ones who've got their finger on the rate button. And all I keep hearing is that they're going to keep going until they get this under control. It's a mission for them. So it doesn't matter if PCE drops. It doesn't matter if the economy weakens, until they tick all the boxes to say, yep, we've done the job. They're going to keep hiking. And if that's rates to 6%, we could find rates going to 6%. I'm not going to rule anything out. So anyway, I'm just going to say, it's a question that sitting here today, are the Fed winning on inflation? I'd say no.
Not yet. Not yet. No.
There's nothing to say. Even now we've got oil going back higher again.
Yeah. One thing I wanted to say, Paul is asking, can they let the dollar be this strong for long? Historically, the answer is no. If you go back from the 70s onwards, the only two times we've been at these levels in the dollar or above is the late, 1981 to 1986-ish, when we had huge, big inflation, rates going up massively. I think the dollar index, the equivalent dollar index, spiked above the equivalent of like 150. Then we had in 2001, just before the crash after that. But if you look at how the dollar rises and then it falls really quickly, same thing in the early 80s, same thing 2001, 2002, it spiked up and it went really fast down. And that shows you the world cannot have a strong dollar for long. Emerging markets are in all sorts of trouble, and generally it's the reserve currency. It cannot be strong for long. That's a given, and that's been proved over and over again over the past decade. So, we're seeing this very, very sharp rise in the dollar index. Could it go further? Of course it could. Could it go towards 115, maybe that top 120? Yes, but I bet you it's going to come back down equally fast.
Yeah, agreed on that.
Yeah.
Okay, we'll just move it on now, keeping in the rate theme. The Times was out of the piece showing that UK market rate expectations keep ticking up. We've seen over the last week, or particularly since I come back from holiday, rate expectations largely by March indicating 3.5% in the first instance, then it went to 3.75 and now it's up to 4%. So expectations for UK rates creeping higher. Now, why this is important is sometimes you've got to do the maths of this. So if the market is expecting 4% by March, we've got 4 meetings before we get to March. So that makes it, we need at the current rate 1.75. We need 2.25 in hikes, which works out 56 basis points a meeting. Now, obviously, that's higher than 50 basis points a meeting, which you might expect they'd go 25s, 50s, 75s, that sort of thing. So that indicates we need hikes of more than 50 basis points a meeting, maybe a 75 chucked in for good measure, to get to that 4% mark by March. So that's sometimes why it's important to have a look at how many meetings there are to work out what the hike expectations are. So from the market's perspective, it's raising how much it thinks the Bank of England is going to hike by. Now, again, this might fall into something at Jackson Hole because Bailey's up and due to speak. He may comment on market expectations and update on where they see rates going. So again, it could fall in that we get some comments that either confirm the market expectations or go against them. And then potentially we've got another gap situation happening on Monday if the market decides to write down those expectations based on something he said, or even write them up again. Although we're not seeing huge moves in the pound on the back of this, there's bigger fish to fry, as we've seen from a lot of the market. Rate expectations, if they're not the Fed or ECB, they're really going by the wayside. But if we do get a move, I would expect to see something more in pairs like euro sterling or maybe pound yen rather than cable, because you're going to need to look at the currencies that are going to have widening or bigger widening monetary policy divergence. And at the moment, that's not going to happen with the dollar and the Fed and the BOE. It's more so potentially going to happen with the euro and the ECB, and obviously the Bank of Japan, who are still sitting on their asses doing nothing. So one thing to keep in mind there over the weekend. Looking at some of the Russia stuff, it's Ukraine Independence Day today. A lot of talk beforehand about the potential for a big Russian attack. I don't know if that's a bit of a ploy from Ukraine to highlight the day and make it such a watched affair that it may force Putin not to do anything, because if everyone's expecting it, he's not going to do what everyone wants him to or expects him to do. So look out for potential antics. We did hear a rumor this morning of an impending big air offensive from Russia. That was just a Twitter reporting a Telegram message. So big bags of salt with that. But there was an article out from Politico who's saying that Russia could backdoor its oil to Iran if there's a nuclear agreement. Essentially, that if there is an agreement, that opens the door for Iran to start exporting oil again. And that the thought here is that Putin could sell oil to Iran in the back door, they refine it and shift it on, or indeed they use Russian oil for their own domestic purposes and export their own oil that way. So not something that was going to be a shock to anyone about backdooring stuff from Russia, but here we go with the stories again and the ways that Russia can get around the sanctions. So that's, I'll double check that, I think is it on the that I've got on the news and items. I don't know if you guys have got anything you want to add to that, anything I've missed or you've seen or want to add?
Not from me, no. You've done a very, very thorough job.
Yeah,
Thank you very much.
2 pages more than what I had written down. So good job, man.
Yeah, I like doing my homework. It takes me about half an hour, but there you go. Right, so let's get into some of the price action going on. As mentioned, well, we'll start with euro dollar. I was a bit miffed with this one, to be honest with you. I was sitting pretty in shorts from the big figure up here yesterday. Hovering down here to see if we got a break of 99s. I did take a chunk off. I had got half the trade away down at 05, so I'm not going to complain too much. But I got my trailer pinged by 3 pips. I had my trailer at 15, and it got pinged at 18, or the high was 18. And now we've pretty much gone back to the middle of the range between yesterday and today. So this is what we're faced with at the moment. You know, data today. We've got the NBA. Durable goods. I'm not sure if we've got anything else. Let me double check. I think that's it. So we're still pending home sales as well, but durable goods is probably going to be the main number there to keep an eye on. So yeah, it's, again, just to repeat, it's showing what I've been expecting this week, that we're going to see a bit of to and fro on the data, and as people jockey around for positioning ahead of Jackson Hole. We're in the middle of the range here, so no, I'm pretty neutral based on that. We've got this long-term trend line from 2015-16. The price, again, is just mooching around. It doesn't know whether it wants to stay above, get below. So from a longer-term basis, keep an eye on this. If we do start to find support on it, and whatever we do over the months ahead, it's a level that you need to keep an eye on if we come back to it. But it is having a little bit of a say while things are quiet, as you can see there. You know, we had a bit of up and down yesterday, find resistance, find support. Today it's support. Not a line I'd actually probably trade off of, but it's an area of interest. Guys, what are your thoughts on euro dollar here? Bit in no man's land?
Yeah, go on.
Yeah, I think we could be, well, at least until Jackson Hole, ranging a bit. But interesting to me is rather than euro dollar are the euro crosses still, which are still very heavy, in my opinion. When the dollar move was done, euro actually strengthened slightly or a little against on the cross side as well. Just because of a weak number not being too good for risk, but then straight away, once the dollar had done its major move, euro immediately started to weaken again on the cross side, and I think for me that's more interesting than actually what's happening in the euro dollar ahead of the whole.
Yeah, cool, mate. And yeah, I'll let you look at the crosses when you do your little round robin. Still, your thoughts?
I'm not doing anything before Jackson Hole, but you know, the euro at these levels, what's, you know, if you think about what's priced into it, you know, total catastrophe over the winter and everything, you know, all it's going to take. I was discussing this with a friend of mine. He's not a trader, but he's a very, very successful businessman here, a very smart guy. And he goes, you know, it only takes one headline, one little compromise in the Ukraine situation, you know, whatever that is, and the euro is going to absolutely fly. So if you short the euro here, you're picking up pennies ahead of the steamroller. And the problem is, what more needs to be, the question is, what more needs to be priced into the euro for this to go lower? Or what more needs to be priced into the dollar for this to go lower, for euro dollar go lower? You know, we're pricing still hikes for the Fed. The Europe is going to be destroyed, and you know, so I'm very scared when things go so far one way. But as I said before, I'm not touching it before Jackson Hole.
Yeah, no, I agree. I think we're potentially getting into a situation where the market now needs to see how bad things are going to be over the winter. As you say, we might be getting to a point where, you know, bad weakness or whatever negativity is priced, but the market will want to see if it's going to be as bad as what they expect. If it's not, then I agree with you, we should see the euro rise significantly. Obviously, any positives to do with the war is going to see the euro fly naturally. But yeah, I think it's a question of no one wants to buy the euro right now, but they're going to need to see how bad it's going to be before we either get another leg lower or we reverse, like you say. But trading wise, what can we do? We can guess whether it's priced or not. We could say it's been priced for the last 6 months, and all it's done is gone lower. All we can do is watch the levels. 99 is the number at the moment. If there is another leg lower, it's got to break that. If we get another test over the next few days, if we get something hawkish or non-dovish from Powell that sees the dollar bid and we can't break this level, that will be a big signal that perhaps we found the bottom, and that's when you start to look for your trading opportunities. So it's purely from trading point of view. Whatever we talk about, whatever our views are, the levels will decide which way and what the price is going to do, and that's all we can trade. Kay, do you want to take it and do your little around the grounds?
Yeah, sure, mate. I was just
make sure
trying to find the button to unmute myself. Okay. I need to change something, so bear with me just 1 second. Okay, here we go. Right. So first of all, I'm going to concentrate a little bit on those crosses, as I was mentioning before, because when you look at it, obviously it makes the euro dollar move. But when you look at what happened yesterday, the euro, as I said, once the dollar move was sort of done, the euro dollar started to slide back down, where the others kept their bid. We've seen it on most of the euro crosses. If you look at even the euro sterling. Did slide back down yesterday after those numbers, and that's still a sign for me that the euro is still on the weak side. Look at the euro yen here. On the euro yen, pretty interesting here as well, I'd say. With the short-term triangle, we're in breaking territory. It was around 136, the figure. We're trading 135 3/4. Keep an eye on that 136, the figure. It's been a traffic zone in the past as well, this area. So let's keep an interested eye on the euro yen. I'm not going to trade it until the whole either, because I don't know what Kuroda is going to come up with. So far, he hasn't moved an inch, and we must say that the government has been doing most of his job by putting in place all those stimulus packages. But he can surprise. We have, for those who were in the markets then, still, I think it's Davos 2016, where he laughed inflation away, and we had an absolutely huge move on the back of it in yen. So let's keep this one close in mind for what's going to happen over the weekend and past it. Then the other ones that I want to have a look at is still in this one as well, the Euro CAD. It did break back down under 130, 25.30. Then it tackled the past lows, the July lows. And in my opinion, there's a chance we are now going in. We would now there's a possibility we're going to see this 127.20 3/4 zone. I've traded it around. I've just been done on an intermediate on a small take profit at the figure. So as usual, I am trading my positions around to reduce the risk and to optimize also if we would have some rangy moves coming up, so that my position is getting or close or at in risk-free territory. So that's what I'm usually doing, and it won't be any different this time. I think the bigger one now has come down for the shorter term, has come down to 130.85 figure. That's going to be a zone that I'm going to be very interested in case we get higher rebounds. On the euros, the same thing. So this reflects as well what I was saying a bit earlier, and this reflects exactly what's happened yesterday after the numbers in the States, and this is exactly what went on yesterday. And the best illustration was this Euro Aussie again. We had a ramp higher. Aussie dollar shot up to 69.5. Euro dollar shot up around parity and above. This is this little move here, and then as soon as the dollar found some of its footing because the 10-year yield couldn't stay under 3%, all the crosses started to slide away again, and this is really a perfect example of what happened yesterday. So I was long Aussie dollar yesterday on ahead of the 68.55 as I showed, and as I told in the room as well, ahead of this level. So it held good, and then on the way up, I closed it and I went back into Euro Aussie because I still think the euro, as I've been saying an endless amount of times, has a lot of weight around its neck, and I still think it's going to be a case. You know, I mean, what's priced in is one thing. Finding buyers is another thing is another thing, right? So because for now, if Europe needs to import a lot of energy, the euro is weaker, and so the imports cost even more because most of the commodities are expressed in dollars. US is exporting energy now to Europe. Europe also has to pay soon, and I think there's already a little bit flowing for Canadian imports. They have to pay for Norwegian imports, and everything is getting only more and more expensive. So the euro is in a bit of a vicious circle for me as well. Just on the side, purely currency related to imports and exports. So yeah, Euro Kiwi, same thing, really same thing. But I'm not in it. But it's still very heavy. Why not go back to 158 in the end? And I was talking about this Euro Norway in the room yesterday. We very regularly have conversations about this because, and I was saying, okay, maybe we can have a look at this 967, and actually we're already trading below. It's trading around 961. So I think it's again an illustration of what we are seeing globally happening in the euro. Of course, Norwegian kroner is also helped by the fact that Brent is back above the $100 mark. And also what the government yesterday said about instead of cutting the energy exports for the autumn and winter to satisfy their own needs, he said the government said that they would rather keep the taps open, free flowing, so they can supply their allies and clients with gas and oil, and that also has put some upward pressure on the Norwegian kroner, in my opinion. So we're already trading lower. I'm trying to sell rallies, but it's a tough one to find a rally, really a decent rally to go and sell into right now. So keep an eye on this one, and I think we can reach low 950s, mid 940s perhaps on the Euro Norway. And then over to what I have running. So first of all, the dollar max still firmly in this downward channel. I had a pretty cool break below this. Where is my 2005? I said the other day 2005.06. Anyway, perhaps I have it on a shorter time. Yeah, there it is. So this one has now given way, and we might be on our way back to 1970s, which is, in my opinion, going to be the big zone to watch. From 80, 82 down to 76 is for me the big intermediate zone on the dollar mix here. So watch that one closely. Um, Euromex don't change the winning team, break, retest in the high 2030s, a little bit up to get some short-term stops done, and then back down. So the next my next target is around low 1960s. That's going to be a relatively important zone because it's a springboard for from where all the fun started back in 2017, and it's been a bit of a traffic zone here. So that's the one that I'm going to that's the one that I'm going to keep in mind now next, and then over to the dollar China. Dollar China. Let's do this. So as I was showing, I think I have to go on the longer term. Yeah, this is the one. So the 685 3/4 broken. Went back below though on yesterday's week dollar numbers. We did go and have a retest of the prior top at 683 3/4, and then the Chinese green light, as Ryan said, to for a small weaker Chinese yuan is has been given again, and so I reckon we have a chance to ultimately go back and have a visit at 697 701, something like that, is really within the possibilities. What else? Yeah, dollar rand is a bit of a strange one. We've had higher, what is it? We've had higher inflation data again this morning, but the rand is a bit defensive right now. But the thing is that for the rand, it's also linked uh, not really to energy, but to metals and commodities, and a slowing economy, the Chinese economy doing a bit less good, and that's keeping the rand on the defensive. Um, if not versus dollars, it's quite it's really on the defensive versus other currencies through the process. Quick look on the oil. Yeah, that's a break. That's a break around 92 and a half, and we're already back in 94s. I think this one I was showing yesterday as well, between 95 and a quarter and $96. It's gonna get interesting on the WTI, in my opinion. And let's not forget, this is where the Saudis started to chat or here the other day, and we are nearly $10 higher. I mean, you have to listen to what people who handle the cash and handle the black gold. You have to listen to what they say, because they do move the markets. So just for the little story. Gold and gold and silver, yeah, still rangy. We are around this 1950 zone, bit in no man's land right here, or we could say we are coming up to some resistance if this is a new triangle also in the making. Could be coming a bit of resistance around 1765 72, and now we have to watch again this 23 28 17 23 28 zone for to see what's happening there, if ever we're getting a retest. I must say though that metals are relatively doing better compared to what yields would suggest. So there may be a bit of, if not technical rebound, there may be a bit of hope that that the metals are finding some of their mojo back. but let's not shout. So on silver, I bought it just around here the other day, and then I've been taking some off on this spike early doors, and around 22 yesterday on the dollar move lower. So now I'm ready to start to and try to catch a few knives again if we see it in the 1880, 1875 zone. And I'm ultimately thinking that if we break 1930, call it 1935.40 or so, 35.39, that we are going to have some fresh air coming into it, and we can move back gradually towards the 20. And that's it for me, Ryan.
Lovely, thank you very much, mate. Right, just before we crack on, just want to share something with you folks. As you may or may not know, we are at Forex Analytics running a traders funding program. I'll pop a little link into there. It's getting a bit of attention now, our program. We've got several things that are real positive over other programs out there. One being that for US traders particularly, there's no FIFO rules. So you can trade around, you can long, short, add, cut, rather than get in a position and do nothing else until you close the position. But also the other big point of our program, which we felt was very important for traders who want to undertake this, is that there's no time limit on qualification to a full account during the assessment. Other programs set deadlines, they can force you into making trades, but there is no time frame for passing the assessment under this program.
There is only one constraint. You have to make one trade every 30 days, but it can be a small trade as you can, which basically is going to make no difference, just to keep the account alive.
Yeah, I was going to say this. The only restriction is an inactivity thing, as Stel says. If you don't touch it for 30 days, then we might think that you've given up and the account gets closed. But otherwise, if you are trading, there is no time limit, so there is no pressure. The last thing you want is time pressure, being forced to qualify for something, and you get near the deadline and you're rushed, you're pushed, and you start making mistakes just to try and get the trade in. You can take as long as you want to pass this, because there shouldn't be time limits in trading. So if you want to check that out, have a look at that. I've put the link in there for you, and you can see that on the screen. I need to update my site because now you can get accounts up to $1 million there. So that
one thing, Ryan, sorry to interrupt. Angela's asking, what's the leverage? The leverage is 10 to 1 for Forex metals and indices. Equities are 5 to 1, cryptos are 2 to 1. But remember, you're already starting with 100 to 1 leverage because you're only the fee is only 1/100th of the amount that you're trading. So
again, that's important. Your risk, if you've got a 100 grand account, your risk is only your assessment fee.
Yes.
You're not risking £100,000. You're not liable for any losses. So if there's a black swan event and something gets blown up, all you lose is your assessment fee.
No other hidden stuff, anything. So effectively, So effectively, with 100 to 1 being, the fee is 1/100th of the account you trade, plus 10 to 1. Effectively, you get up to 1,000 to 1 leverage for FX, which is not bad. Yeah,
but from your risk perspective, if you go and open up $1,000 account, you're only going to trade $1,000 plus whatever 1.2, 1.3 leverage the broker gives you. You do get the bigger leverage, and your risk is still only the $1,000. But anyway, the link's in the chat there. Have a look. If you want to ask us about any part of this, if you have any other questions, do get in touch. We're here to answer your questions. Anything you want to know about it, we want to make sure that this program is right for you. I have no qualms in speaking to people, and I've done so, finding out what they want to do, what they're looking to do, and deciding that maybe the program isn't right for you. This isn't just a money grab, getting people in as many as we can. We want to make sure that it's right for the trader involved. And if it's not, we'll tell you it's not. We don't want you spending your money on something that is not right for you. But anyway, have a look at that. All the details there on the side. As I said, I've got to update a couple of things because the inactivity is now 30 days, not 45, and the account's up to 1 million. So see, now you're costing me money in development because I've got to go on to my developer. But anyway, back to the markets. Kate covered pretty much a lot of it. Still, you got anything you want to add on the silver side? Or has he gone? Is he gone? No,
I think he's gone.
He's gone. Okay, right. Yeah, I've not really got much to add. I'm in a bit myself wait and see mode. The only trade I've got on at the moment is my long-standing dollar Hong Kong, playing the band. I did manage to get some profit off in this move. Again, for those that may not know, the Hong Kong dollar is stuck in a band, or is kept in a band by the Hong Kong Monetary Authority between 7.75 and 7.85. So I'm short right up here. Got a little bit of profit as well, as I said, in this move down. Not as much as I would have liked, but I'm happy to stay short in this one with the potential of a central bank as my backstop. Yeah, for the rest of it, I'm a bit in wait and see mode. I'm going to look at the data. If we get a big move, if it's negative data like we saw yesterday in the US, durable goods, I may think about trying a fade if we get a similar size move. I wasn't looking at it really yesterday. I'm going to be paying more attention to it today because I think that's the way the market's going to be going into Jackson Hole. It's going to buy any dips in the dollar that the market gives it. So on that note, I shall wish you all a good Wednesday. Trade safe, make lots of pips. Thanks to Stel and K-Man. And as I say, if you have any questions on anything, the Flow Show, what we do on the platform, the Traders Funding Program, please feel free to get in touch. You can come via the Forex Analytics website. You can come via my Forex Flow website. Got a contact button up there. You can come and send us a message. Anything you want to know, any questions you have, please feel free to use that. Other than that, thanks, Kay. Thanks, Stel. He'll see that thank you in the replay because he's gone. And have a good day all. See you tomorrow.
Thank you. Thank you, Ryan. Cheers, everybody.